Now we will go into our second panel titled, Do We Need to Change the Way We Communicate? Details of this very important matter. I would like to introduce our two panelists. The first one will be Guillermo Montt, a social protection specialist with the International Labor Organization. And Stephanie Tully is an assistant professor of marketing in the University of Southern California. I would like to introduce the two panelists. First of all, Guillermo, and then Stephanie. Guillermo Montt is a social protection specialist with the ILO. He is based in Chile. He manages projects, research, and support to the southern home countries of Latin America. Before joining the ILO, he was in the research department of the ILO in Geneva, and he worked in employment and education in the directories of the OECD in Paris. Apart from his social protection work, he has also worked on issues regarding the environment, labor, and education. He holds a PhD in sociology from the University of Notre Dame, USA.
Stephanie Tully is an assistant professor of marketing at University of Southern California's Marshall School of Business, and an MSI, I think it is the correct pronunciation, an MSI, a young scholar. She studies the impact of consumer resources on money and time. Her research tackles questions like, how does feeling financially constrained change the way consumers make choices? Why are some sources of money treated differently than others? And how can we encourage consumers to use their time and money to improve their lives? Stephanie's research has been published in top academic journals, including Proceedings of the National Academy of Science, Journal of Consumer Research, and the Journal of Marketing Research, among many others. Her research has won multiple awards and has been featured in popular press outlets such as Forbes and the Wall Street Journal.
So now let's go into the first presentation by Guillermo Montt. Thank you very much, Paulina. I'm glad to see the high level of participation here. Let me share my screen, which is very relevant vis-a-vis what was discussed at the end of the first session. And Paulina invited us to discuss communications, and this leads me to ask what we are talking about when we talk about Social Security reforms. Is it a technical dialogue? Is it a political dialogue? And this is not only technical, but it's more political, is my answer. This is an interchange between regulators and educators, and we cannot ignore the political dimension when we communicate. From that, we have the idea that we have been discussing with different audiences in the field of reform in places such as Uruguay. And I would like to offer some ideas and try to develop this issue further. My experience in ILO is what you see here. We are based on Conventions 102 and 128 and Recommendation 202 of the ILO, which tries to approach pension systems as a protection against poverty and a way to make consumption more uniform. And they imply an intergenerational solidarity and an intergenerational pact. And there are several reasons which explain the political dimension of this dialogue. There are certain principles that are enshrined in these conventions and recommendations: universal coverage, sufficiency, and financial sustainability in these pensions. They must be financed collectively by the state. The state is responsible. They must be uh, non-discriminatory, and there has to be a periodic revision of these regulations. In the ILO, we're very much in line with these principles, and we all agree to different degrees with these principles, but there is agreement when we talk about solidarity, about a mixed system. But we many times do not have the same definition of these principles. And this is where the political dimension comes to play. And it is in the background of each conversation in this area, because these definitions might not be shared by all. And this is one of the reasons why we do not communicate adequately regarding social protection. And many times reforms are not approved due to these differences in concepts. So it's very important to define these principles in a uniform way, because we need a basic understanding of these principles to in order to have effective reforms in this area. So the context of reforms for Social Security is what I would like to focus on, because many times we see that the institutions are not compatible. So in this case, the objectives the objective is to offer Social Security for all, but we need uh, pensions that work in a dynamic context. And we need to take into account the democratic and epidemiological context. We need to see how we can comply with the principles of sufficiency and solidarity. There's a population that is aging, that lives longer, that needs a longer care for a longer period of time. And then we also have an economic and work context, labor participation, the level of income, the insufficiency of employment, and a gender dynamic, which must be taken into account, as well as the profitability of funds and investments and the sustainability of the different actors in the system. These are all different parameters that we have to take into account, and they must be adequate according to the political context. The political context involves the legitimacy of the actors, the value of inequality, and others values that are more that have greater priority over Social Security. So with this context, we have to think about the steps we have to follow. We start from a technical perspective, and of course, we must assume that the values or the policies will not change, but sometimes an economic factor changes in such a way that we need to take into account another pillar. We need to have reforms that are adjusted to this political, economic, and labor context. And we have to have a common understanding in this regard. And many times, these reforms are difficult, but does it have to be that way? We have a background of regarding the pension reform in Chile, which was a successful experience of public policy changes in the democracy. And I would like to point this out because nowadays it's very difficult to see successful experiences in the area of Social Security report. Many times they are left behind, or they are not placed in force, such as in the cases of Chile. In Chile, we had two failed attempts to reform Social Security, and they were not approved by Congress. And there were other countries that are starting along this road: Uruguay, the DR, Colombia, Peru, and Panama among them. So, in general, these reforms have been difficult, first because political eras are not equivalent to social security era. Many times, the priority changes in these countries depending on different alliances and the popularity of the executive branch. But more than that, many times there's a loss of legitimacy in the process. And this has to do precisely with communication, because many times we do not agree on the principles that we are debating. The diagnostics was not developed in a legitimate way, or it doesn't have full support. And reform proposal might not be uh, legitimate. It might not be accepted by the population in general. So the solution to this, obviously, from the point of view of the ILO, is a dialogue. Uh, Social dialogue can help uh, give legitimacy to the process. It's easy to say, but why a dialogue? Who should take part in this dialogue and how? And it's a political issue that must be resolved in order to promote this dialogue. And we need to review the basic concepts in these dialogues, and this is why we go back to the political facet of this reform. The government, the workers, and are main actors in this dialogue, and they must participate. But other interested actors should also take part. For example, retirees and others who are affected by these reforms, and of course, Congress as well.
So how can we advance this reform? It is always important to define the political direction of the system. And here I'd like to refer to the debate in Chile. When we talk about a hybrid system, there are some who agree with that, and others say we already have a hybrid system. We have three pillars. There is a non-contributory pillar, a contributory one, and a voluntary one. But that's the end of the conversation, because the two groups are at loggerheads discussing the same issue, however. And the same thing with solidarity, the responsibility of states, the tripartite participation of social actors. And then often we see that the principle of sufficiency and adequacy, sustainability, all those are there. And the question is, what do we prioritize? And technical aspects should always be subject to the main overarching definition. Unlike the institutional channels, in Spain, for instance, one of the institutional channels is a constitution. And there's the Toledo Pact, for instance, and that kind of structure ensures the validity of the systems. As part of a discussion we had with a former Spanish labor minister, we talked about the fact that in our countries, often the definitions are not clear. In Spain, that is not a problem because it's embedded in the constitution, in the Moncloa and Toledo pacts. So that facilitates progress. But in our region, we don't have this. And I believe it is important to raise the question and be open to this kind of dialogue in order to define the policy directions. Based on that, it is easier to advance in terms of a shared diagnosis. If this is what we understand by hybrid system, by role of the state, based on the definition of each of those things, we can decide whether goals are being met or not, whether principles are being observed or not, according to the way the principles are defined, because the principle may be one thing, but the implementation on the ground in each country may be different. Based on that, we can see what factors come into play and also prioritize them. With regard to Chile, it wasn't really clear what the order of importance was, considering the deficit in our system in Chile. There's the job market considerations, the private sector actors, but the specific order is not clear. And that makes the conversation more difficult as the technical reform seems to be prioritizing some factors rather than others. I like the French example. They have a retirement guidance council, which every year by law issues a diagnosis with recommendations regarding the pension and retirement system in France. And the council brings on board a number of multiple actors. So this provides legitimacy and facilitates dialogue to advance towards a common diagnosis. And then we can move on to the technical side of things. If we have a shared diagnosis with an order of priorities that's been agreed on, and with the magnitudes also agreed on, but often we work on the basis of assumptions that are not necessarily shared. And this is also one of the reasons why some of the most recent reports of commissions were not as broadly supported as expected, because the definitions were not really shared by all members of the groups. And then comes the legislative process and the whole congressional discussion process. But based on that, if you have previous dialogue, consensus on the diagnosis and the technical side of things, then the scope for debate within Congress is a lot less. So unless you have some previous basic agreement, the reforms end up being reviewed exhaustively, and this means that there's a mismatch and the process will be longer than planned and experience delays and will not address the needs of citizens. Of course, sometimes these are things that are easier said than done. So what happens when we can't make progress? Well, one option is patch solutions, which is when there is the need for an important reform. Sometimes the solutions that are applied are just little patches that help us deal with the need of the moment, but do not address the fundamental issue. Another thing is sometimes things get swept under the rug. The third option is a panic button, an automatic solution like what they have in Canada. In Canada, pension reforms require agreement by 2/3 of provinces as a whole, accounting for over 60% of the population. And if no agreement is reached, when identifying actuarial imbalances in the system, the contribution rate increases half the amount needed to cover deficit, and indexation is frozen. This is an automatic solution that requires political agreement. The political system obviously doesn't want to be responsible for increases in contributions. Although it is an automatic solution to control actuarial deficit, it obliges the political system to take the initiative and reach agreement in order not to have voters against them. So what lessons can we draw from this to guide reform process? Again, there's the need for the technical side to also consider the political side of things. There has to be ongoing dialogue, recognizing the political dimensions, and the interlocutors and audience need to be well informed. And this is why it is so important to advance with pension literacy processes, but that also requires political dialogue. It is also important to put in place mechanisms to institutionalize dialogue, such as the examples I mentioned in Spain and France. And we should also institutionalize adjustments. In other words, they should be either built in regularly or regularly reviewed. This keeps the conversation going. And of course, this again links up to the political dialogue. Reforms are necessary and regular, so conversation has to be ongoing. But it's also important to show good faith, sacrifice, and shared responsibility. Both need to be shared. There has to be a fair distribution of the social responsibility in order to have a universal, adequate, and sustainable system. But we as technical actors need to recognize the political dimension, even though that may require going beyond our own comfort zone.
So thank you very much, Guillermo. Now we will proceed with Professor Tully. I just want to say that this is a out of the box for us regulators, how to think about changing behavior or trying to make people to make the right choices. So Stephanie, please, the floor is yours.
Thank you so much for having me. And yeah, very much as Paulina said, I'm going to be taking a different tact than Guillermo, who's talking about it from a systemic level. And what I want to share with you is some research I've done on how language can impact how consumers respond to these types of reforms that you might consider doing. And so hopefully you can see my slides now. But again, I'm going to be talking about it from kind of the psychological perspective of how consumers might or constituents may take the changes that you might think about making. And so just before I begin, a little bit about myself so that you know about myself. I know Paulina did a great job, but my training is from NYU here in America. Then I started at USC, which is the University of Southern California. I was at Stanford for a few years and just returned to USC to be closer with family. I've also done a number of industry consulting and collaborations, and I just wanted to point out here that I have worked with both financial institutions, but also government agencies such as the Federal Reserve here in America. And in particular, the Federal Reserve is looking at what I'm going to be sharing with you today, which is about the psychological ownership of money. And so my work very much builds on a growing body of research on what we call the mental accounting of money. And so some of you may be familiar with this, others may not. So this is the idea that people treat money differently depending on factors such as the money's origin and intended use. And so as a couple of examples of this, for instance, labeling savings accounts, like what you're going to plan to use that savings account for, can change people's savings behaviors. Describing charitable donations as spending money rather than giving money can change people's willingness to donate money. This research is very much along that same line, but it has some really important implications for things like borrowing money, the use of government benefits, pensions, etc. And so the idea of psychological ownership relates to the extent to which a target feels like your own. This is distinct from legal ownership. So regardless of whether you legally own something, you can feel like something is yours to a lesser or greater extent. And so what I'm going to be sharing with you is some research we've done looking at how this impacts people's willingness to use borrowed money to go into debt, their interest in claiming government benefits, and then I'll talk about some implications and applications that I think may be relevant to all of you. So in terms of borrowed money, right, when we think about debt, it's something that's typically owed or due. It's an amount of money borrowed by one party from another. It's inherently the use of money that is not yours. Yet, despite this definitional quality, we find that people can vary in the extent to which they feel like that money is theirs. And so on one extreme, you can imagine people feeling like money is not at all theirs. This is the bank's money. This is not my money. On the other extreme, people could feel like it's exactly like money in their bank account. It's like money in their pocket. It's just their money. And so what we do is we look at whether individual differences in people's propensity to feel like psychological ownership of money, of borrowed money as their own, predicts their willingness to use borrowed money. And then we also look at how context and language can impact psychological ownership and change that. And so to give you just some idea of this, I'll go through a couple of studies at a very high level, but I'm happy to answer any questions about these later on as well. This first study just looks at, does people's natural differences in their propensity to see borrowed money as their own money, does that predict differences in willingness to borrow? And so this was done with online participants where we measured their psychological ownership using just a couple of agreement questions. And then we look at, does this predict their willingness to borrow money using a credit card and their willingness to borrow money using a personal loan? And for both of these things, we see that people who indicate that they feel like borrowed money is their money are more willing to borrow using a credit card. They're also more willing to borrow using a personal loan. And this is their future intentions, but we also measure their past behavior. And we see that people who have higher psychological ownership of borrowed money have used a credit card in the last year more. They are more likely to have used a personal loan in the last year, and they're more likely to have used any sort of debt that could be plausibly used to make discretionary purchases, purchases that aren't really needed, that are more fun type of purchases. Now, we also measure a number of other psychological constructs, but importantly, psychological ownership of borrowed money was the only construct that predicted both all three past behaviors as well as the two future behaviors. And its ability to predict future willingness to borrow came above and beyond all these other things that you might be thinking of, like debt aversion. So I've shared with you that people, individually can feel different levels of psychological ownership of borrowed money, but there's also important differences across contexts. And in America, the most common forms of borrowed money for consumers to use are that in the form of credit or lines of credit and loans. Economically speaking, these can and are sometimes used interchangeably, but they're often named in part due to different common differences in structural properties. And what we find is that psychological ownership of credit is higher than psychological ownership of loans. And I'll give you some examples of this and show you why it matters from an economic perspective. So here, what we first did is just try to look at, do people think about credit cards and loans differently? And do they use different language to describe credit cards and loans? And so what we did is we came up with pairs of search terms that could be used with credit cards and loans. So things like my credit card money, my loan money would be higher in psychological ownership, whereas borrowed credit card money, borrowed loan money would be lower in psychological ownership. And we collected the relative search volume using Google search trends for 52 weeks for these different pairs. And then we analyzed these, and what we found was that credit cards are searched more often than loans when they're accompanied by higher psychological ownership terms, but loans are searched more often than credit cards when accompanied by lower psychological ownership terms, suggesting that people readily think about these types of debt differently. And so now what I want to share with you is some research in which we can explain why consumers may be more willing to borrow for some credit card types, for some debt types than others. And so this was an experiment in which we tried to isolate the impact of debt structure. So you could think about, is this just because credit cards are revolving in nature or something like that? And so what we do is we isolate that by using the same debt, but calling it either a flex loan or flex credit. And this is actually a product that is available in one of the states in America here. It's called a flex loan. It's available in Tennessee. And what you see at the bottom is that it is an open-ended line of credit. So we gave our participants information about this, but either called it a flex loan or flex credit. And so we first had people write about a fun but unnecessary purchase that they wanted to make for themselves that cost between $50 and $1,000 in US dollars. And then we told them about this opportunity to get access to flex loan or flex credit. And we gave them lots of information about it. I don't expect you to read it all here, but what I will tell you is that we had a number of comprehension checks to make sure that they understood the structure of the financial product. And so, for instance, nearly everyone understood whether it was revolving or not. In this case, it was a revolving line of credit or loan. Nearly everyone understood that they didn't have to start repaying this until after they've spent the funds, that it was available on a convenient card that was accepted anywhere that Visa is accepted. And nearly everyone understood whether they had received an option called flex credit or flex loan. So none of these varied by condition. So some people got the flex loan option, some people got the flex credit option. Everybody understood structurally how these work. Yet despite that, we saw that the people who received the flex credit option were more willing to use the financing offer we had given them to make the purchase they had written about at the beginning of the study. Moreover, they indicated having greater psychological ownership of that money. And that difference in psychological ownership explained the difference in willingness to use the financing offer. Right? And so this is some evidence that, you know, people holding the structure constant, the way that people view money psychologically, and in particular in terms of their psychological ownership, can change whether people want access to it and whether they're willing to use it. And so in the next study, we go a little bit further to say, if this is really about psychological ownership, then if we describe the money differently and try to change their psychological ownership, we should be able to change their willingness to use this money. And moreover, we examine this relative to economic factors, specifically the interest rate. So how do we do this? So in a control condition, some people got the loan or the credit option, and we tell them similarly to last time that they either get this loan or line of credit that's revolving in nature. And then we tell them that there's an interest rate. And in line with what we see in America, where credit lines often have higher interest rates than loans, the credit line here has a 15% interest rate, and the loan has a 10% interest rate. And so if people are going off of economic factors, they should be more interested in using the loan than the line of credit. But if psychological ownership is a bigger driving force, they might still be willing to use the line of credit more than the loan, despite the fact that it has higher interest rates. But in addition to these two conditions, we add two more conditions. And again, they get loan or line of credit, but here we add language to remind them that this is borrowed money, that this isn't their own money. And so it's the same information, but what you see here is that we've added some language in bold to reaffirm the idea that this isn't actually your money. Even a line of credit isn't your money, it's the bank's money. It lets you borrow it. Other than that, everything is identical. But the idea here is that people that are thinking about loans are already thinking about it as borrowed money and not their money. People in the credit condition are more likely to be thinking about it as their money, so this might affect them more. And what we see is that in the control condition, we replicate what we saw before. People are more willing to use the flex credit option as compared to the flex loan option, even though this is more expensive. This has a 15% interest rate instead of a 10% interest rate. Okay, and so these feelings of psychological ownership seem to be more influential in their decisions than the economic factors. And we see that this difference in interest in using the flex credit option and the flex loan option is eliminated, and specifically people are significantly less interested in using the flex credit option once we've reminded them that this is really borrowed money. Okay. And so now what I want to share with you is how we then use this to try to increase people's feelings of psychological ownership in the realm of government benefits. And so here we're looking at their interest in claiming government benefits. And this was work in collaboration with Code for America, which is a non-for-profit organization that tries to help low-income consumers get access to government benefits in America. And so many of you may be aware that there is a significant participation gap despite the fact that means-tested government benefits are really helpful and contribute to a range of positive outcomes like alleviating poverty and improving education, a lot of people don't apply for these benefits, leading to substantial non-take-up of benefits across the globe. The existing work primarily focuses on increasing awareness, letting people know that these benefits exist, or reducing application complexity or structural barriers. These are undoubtedly important and certainly helpful, but we wanted to look at a particularly a different approach that doesn't involve quite as cumbersome changes and might change things just by increasing people's interest in claiming those government benefits. And so here was the idea that psychological ownership interventions could increase interest in applying for government benefits. And we thought this was likely because, one of the reasons that people may not apply is because it feels like asking for help. And if it feels like asking for help, we know that people don't like to ask for help. Yet if you make those same funds feel as though that those are their funds to begin with, it will maybe make it less of an uncomfortable ask for help towards a more rightful claim to what is your own money. And so what I'm going to share with you, we have a series of large-scale field experiments. I'm going to share with you just one of those today. And the one I chose is because we compare our psychological ownership intervention to some other behavioral science interventions that have been used in other contexts. And so this was done in collaboration with Code for America. As I mentioned, they identified people out of their information who would be eligible for the Earned Income Tax Credit, which is a tax credit in America that's based on the number of family members you have as well as your income. And so here what we did is we messaged 10,000 individuals who should qualify for this tax credit based on one of 4 different messaging. And so in the control condition, they received a message that said, we believe you're eligible for a tax credit. The amount of money that they were eligible for was input and customized based on their family size and income. Said it's easy to file. If you haven't filed your taxes yet, you can do it online for free. And we provided them a Code for America's website that helps guide them through the process. In the psychological ownership condition, we said, we believe you have a tax credit that belongs to you. It's easy to file to get your money. If you haven't filed your taxes yet, you can do it online for free. And we provided them a website. We added a deadline condition. This study was run within 1 week of the filing deadline. So we reminded them in this condition to file before the deadline because urgency, a sense of urgency, has been shown to increase people's likelihood of taking action. And then 4th, we added what we call a social norms condition. And that's telling people that lots of other people are doing this behavior. So we told them millions of people like you have filed their taxes. And so this is to instigate this feeling that lots of other people are doing it, you can do it too. And what do we see that happens? With the control message, about 20% of people go to the website when they get the message. This increases to 27.5 when they are reminded that there's a deadline, suggesting that that does in fact increase people's likelihood of taking action. The social norms in this condition actually backfired, and we didn't expect this to happen, but it reduced people's likelihood of going to the website significantly. I have some post hoc explanations for why that works, but I don't think that's relevant to today's talk. And then what we see is that the psychological ownership messaging significantly outperformed all 3 other conditions. Now you might say, maybe this is just curiosity. Well, we see whether they actually start the process of claiming their benefits by starting the filing process. And we see that that does continue. So it doesn't seem to be just a curiosity. We see that people are more likely to start the process of claiming those benefits. And so this is nice because it's really simple. If you're already messaging people, you can think about how that language that you use can change people's likelihood of taking action. And so now I just want to share with you a couple of implications and applications that I think may be relevant for this group. First, in terms of new payment forms, or even the naming conventions of different pension-related funds that may be available to people, if you think about the role that psychological ownership might play, you can think about its impact on behavior. So for instance, in terms of borrowed money, many of you may not have credit cards as a readily available form of payment, but one that is growing in popularity is buy now, pay later. And there's many reasons to believe that over time, this is likely to have high psychological ownership, which might lead consumers and people in your country to get a lot of debt. One is simply the naming convention, buy now, pay later. You're talking about payment forms rather than borrowing. People may not think about it as borrowing. Also, these types of payment structures where sometimes it has interest rates, sometimes it doesn't, may be particularly susceptible to higher psychological ownership. So for credit cards, for instance, if you pay it off at the end of the month, there's no interest. But if you don't pay it off, there is interest. Similarly, some of these buy now, pay later options don't have interest, but some do. And over time, they may be more likely to. And so if people start using it at a time when there's no interest rates, they may be more susceptible when there are interest rates because they aren't thinking about it in the same way. They're feeling like it's more like their money. And the same goes for how you might talk about pensions and the naming conventions of the different options. Social Security, for instance, in America tends to have higher psychological ownership, in part because people pay into the system. And even though the amount that they're paying in is not the money that they pay in isn't sitting there waiting for them, people have this perception that it is. And in fact, some research has found in America that people that have higher psychological ownership of Social Security money are more likely to start taking it out at a younger age, which does have implications for how much in benefits they are able to get over the course of their lifetime. Similarly, you can think about website and application language. And so these are simple things that you can think about how it's structured when you tell people about the available benefits, using language like your benefits rather than the benefits, using messaging like claiming the money rather than applying for the money, using messages like money or tax credits may be different than talking about it as aid or help or assistance. And this is actually some work that we did with a bank, and I've kind of hidden the logo here for anonymity, but where they were thinking about how can we change the layout of this to try to encourage more people to apply. And so you can see this is a pretty standard way you could ask for this. And this is already some work they had done after seeing some of our research. So it already tries to get at some of it, but you can see that rather than saying, apply for the benefits, you can say claim your benefits. Rather than saying benefits, you can say your benefits. Simple changes like this might be ways to encourage people to take action to get the money that they are eligible for. So in summary, what we find is that seemingly basic financial decisions are to some extent discretionary and based on people's willingness to do this. And psychological ownership of money is an important determinant of consumers' financial decisions. So psychological ownership predicts interest in accessing different monetary resources, and in some cases at least can be more influential than monetary factors or economic factors such as interest rates. These perceptions vary both at the individual as well as the contextual level, but importantly, naming conventions and changes to messaging may be able to impact psychological ownership and can be used to either increase or decrease interest in accessing funds. And with that, I just want to thank you. I welcome all of your questions. And if any of you have interest in doing anything about this and want collaboration help or thoughts on that, please feel free to message me.